The recent explosive surge in ICP trading volume is a powerful, flashing signal, but it's hiding the real story, a story that could completely reset the long-term value proposition of your investment. Forget the usual hype cycle for a moment. What if the catalyst for ICP's next major move isn't a new partnership or a trending AI narrative, but a single, critical line of code currently awaiting a vote? What if the key has been buried in the network's own economic machinery all along? This content is for educational purposes only. It does not constitute financial advice or endorse any investment or cryptocurrency. Information is based on publicly available sources. Always do your own research before making any financial decisions. Welcome back to ICP Today. The entire ecosystem's attention is now laser-locked on Mission 70, a comprehensive proposal with one audacious goal: to fundamentally slash the internet computer's inflation rate at its source. This isn't a minor adjustment or a simple tweak to staking percentages. This is a direct, surgical intervention into the blockchain's financial bloodstream, designed to buy the ecosystem the one thing it is perilously running out of: time. And the starting point for this entire desperate rescue plan? A single, controversial, and expensive group that has become the network's undeniable financial anchor, weighing down its potential. Today, we are tearing back the curtain completely. We will expose why this one specific, recurring multi-million-dollar expense is forcing the NNS to consider drastic, painful action. We will decode exactly what a proposed 40% cut really signifies, not just for node operators, but for every single ICP holder. And most importantly, we will connect the dots to what this all means for the fair price of ICP moving forward. Is this the hidden, unspoken reason the price is finally showing signs of life? Let's find out. Guys, 99% of people watching don't subscribe to this channel, so please take a second to hit that subscribe. It really helps the channel grow. Okay, let's dive straight into the heart of the issue, leaving no stone unturned. Mission 70 is a multi-pronged strategy to reduce inflation. But to grasp its immense weight and urgency, we absolutely must begin with the blockchain's single largest, non-negotiable monthly line item: node provider rewards. Let's be crystal clear and brutally honest here. This is the real, tangible, cash-out-the-door expense for the internet computer. The network can technically survive a period with fewer stakers, but it grinds to a catastrophic halt without these physical machines. These nodes maintaining constant, reliable uptime. They are the literal backbone. Yet, for years, this crucial payment system has been problematic, controversial, even a source of community drama. The rewards have been largely fixed amounts, completely disconnected from actual performance, merit, or even consistent uptime, leading to documented instances where providers were paid significant sums even during periods of suboptimal or incomplete operation. It's a system that grew out of necessity at launch, but has since become a glaring economic inefficiency. The proposal gets hyper-specific, targeting a critical and expensive division: Generation 1 nodes versus Generation 2. These Gen 1 nodes are the original hardware purchased by the DFINITY Foundation before the network's genesis. The incentives here were set astronomically, deliberately high to guarantee absolute stability and robust participation from day one, to essentially bribe the network into existence. That primary mission was accomplished brilliantly, but that era is now decisively over. The current data reveals a staggering, unsustainable economic imbalance that can no longer be ignored. The estimated true monthly operational cost for running a node, factoring in hardware, co-location, power, and bandwidth, sits realistically between $300 and $800. Now, what is the average monthly reward paid out to these Gen 1 providers? Roughly $2,500. Pause and do the math with me. That's a reward-to-cost ratio fluctuating between 2 and 5. That implies an operating profit margin of 200% to 500% for those specific operators. This isn't just a healthy profit. This is a massive economic subsidy. So, the critical question: where does that extra massive amount of capital paid out month after month actually come from? It flows directly from you, the token holder, through relentless, built-in, protocol-level inflation. It is literally minted into existence, diluting your holdings to cover this immense gap. The proposed remedy within Mission 70 is intentionally blunt and effective. Cut Generation 1 node rewards by a decisive 40%. This adjusted level, the analysis suggests, would still allow the vast majority of providers to cover their real costs and retain a reasonable positive operating margin while aggressively reducing the constant sell-side inflationary pressure emanating from these legacy nodes, many of which are reportedly underutilized or not fully optimized. But here lies the genius and the immense urgency embedded deep within ICP's unique tokenomics model. Node providers are contractually paid a fixed amount in US dollars. Let that profound mechanic sink in for a second. If the ICP market price is low, say $5, the protocol must mint and distribute a huge dilutive number of new tokens to meet that fixed dollar obligation. If the ICP price rallies to, say, $20, it pays out far fewer tokens for the exact same dollar figure. This creates a powerful, non-negotiable, mechanical feedback loop. A higher ICP price directly and automatically results in lower inflation. It's an inbuilt economic miracle waiting to be triggered. So, is the secret, unstated goal of Mission 70 to artificially pump the token price? Indirectly and structurally, yes, but not for mere speculation. The goal is to use the market's own mechanics to establish a sustainable, healthy economic foundation so the entire project can finally breathe, grow, and stop choking on its own inflationary supply. There's another layer of sheer savvy embedded in this proposal, the move to stagger the monthly payouts. Currently, the system is clunky and predictable. All providers are paid in a single lump sum on a specific calendar day, historically around the 13th of each month. This creates a predictable, monthly sell event on exchanges, as operators offload a portion of their tokens simultaneously to cover real-world fiat expenses like bills and salaries. It's a built-in market manipulation event. By distributing these payments evenly throughout the month, the proposal intelligently smooths out this artificial, predictable selling pressure and significantly dampens opportunistic market speculation around these dates. It's a simple yet profoundly effective operational upgrade. The bottom line is this: the node provider reward cut is a necessary, painful pruning of the network's biggest real-world expense. It is the first, most logical place to apply financial pressure. But understand this clearly: Mission 70 is a multi-act play. This node provider adjustment merely sets the financial stage. It stops the bleeding. The next, even more critical acts waiting in the wings involve the hard work of supercharging genuine ICP demand through platforms like the transformative Café AI and the explosive potential of fully decentralized AI models running on-chain. And, of course, the hot-button, emotionally charged community debate on adjusting neuron voting rewards. We will break those massive topics down in separate dedicated videos. First, we must become master chart readers and interpret the tea leaves in the current volatile market data. What is the market trying to tell us right now? Recent on-chain and exchange activity is flashing some compelling yet deeply curious signals that we must decode. Open interest on major derivatives platforms like Binance is climbing once more, indicating either expanding trader participation or increasing leverage exposure, often a precursor to volatility. Simultaneously, spot trading volume is skyrocketing back toward levels we haven't seen consistently since the major spike last November. It's a clear spike in attention. Furthermore, the number of new ICP addresses is growing at a noticeable pace, a classic sign of new interest entering the ecosystem. However, crucially, the total amount of ICP held on centralized exchanges is actually dipping slightly. This combination, more new people but less ICP on exchanges, typically signals accumulation. It suggests new buyers might be moving tokens off exchanges into self-custody. But we must be very careful. This is still happening within an overall, persistent inflationary environment. Do not confuse this exchange outflow with confirmed, organic, daily active user adoption just yet. It's a hopeful sign, not a confirmation. Meanwhile, the network's raw technical performance remains utterly undeniable and world-class. We've seen days with over 90 million transactions processed seamlessly. The underlying technology, the chain's speed, its capability, it's a proven 10 out of 10, an engineering marvel. But let's be brutally, painfully honest with each other. A superior technology without mass, everyday usage is just a brilliant, expensive prototype sitting in a lab. Real adoption, measured in canister growth, cycle burn for computation, and active users, is the only metric that ultimately translates to sustainable, long-term token value. And by that definitive metric, we are simply not there yet. The potential is astronomical, but the realized utility is still in its infancy. This stark realization circles us back, with sobering clarity, to the true, overarching purpose of Mission 70. This proposal is not a magic bullet. It is not a solution. It is a strategic, emergency delay, a financial tourniquet applied to a gushing wound. If it passes and successfully halves the overall inflation rate, it arguably buys the struggling ecosystem perhaps one crucial, precious year of runway. 1 year for canister state and the cycle burn rate to show not linear, but exponential growth. 1 year for AI integrations and smart contracts to gain tangible, real-world traction. 1 year for developers to build and for real, user-facing applications to finally find their product-market fit. Let's be utterly frank. If organic adoption was already booming and the token price was appreciating healthily on its own merits, absolutely nobody would be sitting here scrutinizing node provider payouts or arguing over voting reward percentages. The entire community would be celebrating the growth. The harsh, inescapable reality we must collectively face is that we are now forced to make these hard, unpopular choices. The binary decision for NNS voters isn't between a 12% APY and a 7% APY. That's a superficial reading. The real choice is between accepting a 7% yield on an ICP token that now has the economic breathing room and reduced sell pressure to become significantly more valuable in the future versus clinging to a higher yield on a token that remains perpetually weighed down and crippled by its own broken economic model. It's a choice between a smaller slice of a potentially gigantic pie or a larger slice of a pie that might keep shrinking. So, with this tourniquet potentially applied, what are the non-negotiable, objective signals we must vigilantly watch for to confirm a true, durable turnaround? I need to see a sustained, multi-month rocket ride in canister creation and cycle burn rate. That is the incontrovertible, on-chain evidence of real-world usage and computation, not speculative trading or token movements. It's proof that people are paying to use the network for its intended purpose. Price action against Bitcoin, the ultimate benchmark, is also profoundly revealing. While the broader altcoin market has bled value relentlessly against BTC for over a year, ICP has demonstrated notable, consistent relative strength in recent weeks. This is a technically promising divergence. But context is everything. We are emerging from a long, brutal, multi-year downtrend where large initial holders, including early backers and VC funds, distributed their token allocations heavily onto the market. That enormous overhang of supply has been the single biggest anchor on price. The data now suggests that this distribution phase, this supply cleanse, is finally exhausting itself. The selling from these entities appears to be drying up, which is a painful but absolutely necessary process for establishing long-term holder health and price stability. The ecosystem is slowly being transferred from weak, incentivized hands into the stronger hands of believers. Now, let's finally confront the existential question every single viewer is thinking right now. Based on this comprehensive analysis, should you buy, sell, or hold? My personal stance, which I share transparently, is one of stubborn principle. I have drawn a line in the sand. I will not sell a single ICP token below a specific price threshold that, in my assessment, reflects the fundamental technological value I believe this project can and should achieve. Consider it a personal, moral line. However, and this is equally important, I am also not allocating new capital to ICP at this precise moment in time. I am in a state of patient, intent watchfulness. I am waiting with discipline for the primary signal I just described: undeniable, sustained organic usage growth on the protocol itself. I have managed my overall portfolio risk by diversifying and covering my initial ICP investment long ago through gains elsewhere, so I personally have the luxury of extreme patience. Your financial situation, your cost basis, and your risk tolerance are undoubtedly different. You must manage your capital and your emotional exposure accordingly. Please remember the ultimate goal here. The goal for the internet computer is not to become the blockchain with the highest staking yield for a depreciating asset. The monumental goal is to build a technological future so indispensable, so scalable, and so uniquely powerful that it naturally, inevitably, and powerfully demands the token. The token must be a prerequisite for the utility, not just a speculative bet on it. In the final, unvarnished analysis, Mission 70 is a desperate, calculated bid for a second chance, a final exam for the ecosystem's economic model. It applies maximum pressure to the wound so the internet computer patient has the critical time it needs to heal and grow on its own merits. It's a monumental, high-stakes bet that with this borrowed time, the developers, the entrepreneurs, and ultimately millions of users will finally arrive. The coming NNS votes are more than governance. They are a collective decision on survival strategy. If you find this deep dive into the future of decentralized technology valuable, support this channel. Make sure to hit that like button, subscribe to the channel, and turn on the bell icon so you don't miss future updates. Thanks for watching, and I'll see you in the next one.